Today I'm revealing several key steps to double your trading performance. We'll cover a variety of topics, including common trading mistakes to avoid, psychology hacks, and some risk and money management tips to be ahead of the game. So, like, subscribe, and stick around for the full video. If you're planning to trade and actually stay in the game for longer, you're going to lose money at some point. And if you want a good trading experience, you must have a somewhat high tolerance for risk. Some people just don't have it. The idea of losing money doesn't sit well with them. Fear of losing money is a good emotion to have in many areas of life. We have to be protective with our wealth. However, in trading, this tendency to be defensive and emotional with money needs to be transformed and refocused into a different mental state. I had this in my first years. The fear of losing money can break you as a trader, causing you to miss out on winning setups and to second guess yourself constantly. But if you want to succeed at trading, you have to conquer this fear. Instead of being fearful of losing your money when trading, embrace the control you have on each trade with the help of risk management. Manage your money, employ a solid risk management, and in time you'll diminish those negative thoughts. Some people love math because typically there is just one right answer. The answer in trading always changes. That's because short-term trading is often driven by human emotions. So many times, people want a formula. If I do this, can I expect this result? If the RSI goes to 30, I buy, right? If I see a doji, that's indecision, right? But the market is too dynamic for that. And here's another thing. You can have a great idea in trading, but if your execution sucks, you will end up losing money. Or you can have the right strategy, but you decide to trade a different market because you really want to trade today. Again, you probably end up losing money. You are only as disciplined as the quality of your method and your belief in that method. No one has a magical crystal ball that can foresee the future. Trading is not about predicting the future. It's about calculating the odds of possible scenarios right. Prices can continue to go way beyond what you anticipate, and calling tops and bottoms without any real method can therefore be very dangerous. Let me repeat, no method can detect exactly where prices will stop. And that's a very common mistake. You have a losing position, and you say, it will stop there, then it will reverse. And you lose, and then you blame your discipline. But it's not your lack of discipline, but a lack of understanding of the basics of the supply and demand of prices and the auction mechanism of the marketplace. Sadly, some traders will never understand this. Some may say that the exit is less important than the entry, which is a big misunderstanding of how trading works. A trading strategy is more than a method of identifying entry signals or finding a more accurate indicator to time your entries more effectively. Exits are equally as important as entries. This is where you decide when to get out and cut your loss, or under which circumstances you realize a profit. Without a clear plan, you are more likely to become unfocused, and you have no chance in a game dominated by professionals. An exit plan, deciding whether you take a profit or a loss, should not be random. You can put your stop at $50, $100, or $200, but if it was decided based on your tolerance, it's randomness. Using reasonable price levels based on technicals, price action in particular, for your stops and profits can often help you to make better decisions. Stops and targets based on what you're happy with will not cut in trading. You need to weigh certain odds prior to executing a trade. Thus, you can decide ahead of time whether you want to be in a trade or stand aside. And keep in mind, standing aside and not taking a trade is a valid option. Based on your own risk tolerance, you should only take trades that suit your personality and your parameters. Stress during a losing trade is often a sign that your position is too big. You must know how to differentiate between scenarios where you take a profit at a certain point, or when it's better to be patient as prices go more and more in your favor. A common problem is taking random profits as soon as you see them, just to regret later that you didn't wait it out. Or maybe you're waiting too long and giving back profits. Again, this is not where you want to find yourself either. And you blame your lack of discipline or greed, which is oftentimes not true. Rather, it's your lack of ability to decide how far the price will extend, because periodically, prices do rest and extend, contract and expand. Your intuition cannot and shouldn't dictate how far you think prices will extend. So let's say you are analyzing Euro USD. You have your bias. You know you want to be long on the market, and you're just waiting for some confirmation. Then you read several articles saying that a short trade is the right play, and you start to question your plan. And instead of going long, you short the market. And you guessed it, you were right in the first place. The market went up. Chances are you are a technical trader, so stick with your technical system and be aware of the fundamental environment surrounding your market. YouTube videos, Reddit posts, or Twitter rumors will easily distract you from your technicals. In the end, your system is what should determine your trades. Others' opinions shouldn't matter. I get asked every day, what is the best time frame? What are the best settings for the MACD or the RSI? You won't appreciate my answer, which is, it depends. The problem is that many new traders don't understand context. Day trading or swing trading without understanding context can and will be fatal to your account. You see, amateurs place the same importance on every scenario. Professionals always adjust their thinking and positions because the market is always changing. It changes volatility, ranges, direction, and bias. You may get into a trade with odds in your favor, while 1 hour later, the odds change, demanding an exit. You don't just sit there and wait for your profit to turn into a loss. You have to be flexible and understand that you need to exit where conditions change. The context of the market will dictate the size of the move and how long a move will last. So you need to be flexible and to adjust to the new situations on the market. It's not how much you know that matters, but how well you know the few things that work for you. Of course, learning is always encouraged, but unlearning what's not necessary, practical, or effective may be just as helpful. For example, in my first years, I relied 100% on indicators, and it was very hard for me to unlearn the way I analyzed the market. I was used to look at indicators to know the trend, and to enter only when 3 of them were aligned, and so on. Seeing too much data can hamper your decisions, whereas having a narrower approach with strong money management may increase your odds of success. Quality of knowledge is more important than quantity of knowledge, and knowing what not to do may be more important than accumulating a clutter of knowledge. One of the most brutal aspects about the market is its volatile nature. The markets can be smooth and trend for a period of time, and then, without warning, run into a volatile sideways and choppy movement that can make trading very difficult. Well, at least for trend traders. Another group of traders might just be waiting for that sideways movement. And that's exactly the point I'm trying to make. Always know the market you are going to be trading in, the market conditions. A trading system will always define the market it is best suited for. For example, you could be relying on a moving average strategy that calls for entering on minor pullbacks within a dominant trend. Or you could be a scalper who benefits from short-term price movements within a wide range. Or maybe you try to catch reversals, which means you're looking out for larger swing trades. The point is, there are going to be phases when you will be enjoying the action from the sidelines. Make sure your trading strategy allows that. A good way of ensuring this is having a strict entry criteria that allows you to stick to certain market conditions for the most part. You often hear words like intuition or gut feeling, but it's very important to distinguish between real intuition and what traders mistake as intuition. A common mistake is when traders use intuition to justify trades where they prematurely entered the market and broke their trading rules. They will then say that they had a feeling that price was going to take off and that they didn't want to miss the trade. But let's be honest, how often does that really happen? Don't confuse intuition with undisciplined trading, because that's what causes major losses. The more room for interpretation in a trading methodology, the more often traders will use the word intuition to justify trades which could have been avoided in the first place. Intuition doesn't only play a role when it comes to trade entries, but it goes much deeper. Intuition is also used to justify staying in losing trades much longer than anticipated. You start sensing that price is about to turn around, and you wait and wait, and that's when the disaster usually starts. Although traders might call it intuition, once you are in a losing trade, your brain starts looking for reasons to avoid the negative feedback from closing out a losing position. Real intuition only comes with years of experience. Is a form of subconscious pattern recognition. After you've spent hundreds or thousands of hours in front of your charts, being exposed to tens of thousands of market moves and patterns, it will become a part of you. You may call it intuition, but in fact, it's nothing but a subconscious recognition of a market pattern you have seen so many times before. Especially new traders should stay away from using the term intuition when it comes to making trading decisions, because what they mistake as gut feel is just a form of undisciplined and unstructured trading. Let me tell you something. Logical and more rational persons have problems when trading. Why? Because markets are irrational most of the time. A logical person often looks for answers to why certain movements happen, but the market is often driven by emotions like fear and greed. I'm a logical person, and it was very hard for me to accept this. Trading is not like school, when you can study hard and know you'll do well on a test. Being too logical in an irrational market can be a detriment in trading. You can't know the outcome of the events before they happen, only the probabilities. If you want to see more videos like this one, leave us a like and subscribe. And check out our Academy program if you want to further level up your trading. Until next time.